Welcome to the Nano podcast. I'm your host, Will Chernlin, and I'm excited to have you join me on this journey through the world of nano companies. For the past decade, I've talked to thousands of business owners across various industries. It's been an enlightening experience revealing the vast tapestries of entrepreneurship and innovation that thrives beneath the surface of mainstream media coverage. Each week, I will interview different leaders of nano-cap publicly traded companies to learn about their history, what they do now, and their future. As a reminder, none of this information is financial advice, and it is all for entertainment purposes only. Let's start this week's episode. Hi, everyone. This week we have John Celenza, CEO of Cizzle Brands, stock ticker CZZLF. Cizzle Brands is an emerging leader in the health and wellness industry with a mission to replace all unhealthy, sugary, and fattening foods, filling our cupboards with healthy and nutritious alternatives. John, thanks for coming on the podcast.
Thanks for having me, Will.
I just wanted to say first and foremost, John, congrats on the last fiscal Q3 2026 results with a revenue up 253% year over year. So caught you at a good time. Things are going well over there. But I would love to kind of dig into your background a little bit before this. What did you always know you wanted to get into business? Did you always know you wanted to get into nutrition? You're with a nutritious kind of beverage previously to this. Is this kind of always something you've been interested, or tell me a little bit more about your background?
Yeah, so I've always been into sports, in particular the marketing of sports. When I was a kid, or I shouldn't say a kid, I was 16. I interned at the NHLPA in their marketing department, but from there I got to work, across the business. So whether it was the PR, the marketing department, even on the licensing side as well. So group licensing is a whole category within itself. And then from there, I had a lot of exposure to professional sports through friends and different associations. And what really dawned on me was the fact that the pro athletes were consuming products that were completely different than you or I. And I said to myself, well, why can't the rest of the world have these types of products, right? It was always of interest for me. So the first business that I co-founded, it was with a childhood friend who was an NHL hockey player. We founded that in 2009. He was really on a quest for the healthiest and safest products in the market, kind of like your brother-in-law that we were talking about before this podcast started. So from there, we put a company together. We sold that business in 2019. So it was a 10-year mission. And then from there, I was, at the time, 2019, 7 years back, I was 37 years old. So still pretty young with a lot of learnings, a lot of battle scars, to say the least. So once my non-compete went away, I decided to get back at it with some of my original team members from back then, as well as some new additions. And again, creating best-in-class products to bring it to the masses. We're servicing the whole pro sports world again. So even though they're sponsored by some bigger brands, they're purchasing our products, to say the least. And one of the key people I worked with in this venture was Andy O'Brien. Andy O'Brien is one of the world's best performance coaches. And Andy, most known probably for being Sidney Crosby and Nathan McKinnon's lifelong performance coaches. They're all out east in Halifax. Or Andy's from Halifax, sorry.
Yeah, no, I asked a little bit more about those battle scars. So more than basically any other industry, people who exit CPG beverage companies, the first thing they do is start another CPG beverage company. And I've seen it over and over again. Is it just because you already have all the connections and so you just can do it like on easy mode kind of the second time because you know how to get into stores and all that? Is there like a certain flavor that didn't really fit with your certain branding, but you always wanted to explore, and so you've been chomping at the bit to kind of go after that? Or like, what is it with CPG, specifically like drink businesses, that like once someone finds one and waits for their non-compete to go up, they can't wait to start another one?
It's CPG's tough, as you know, right? I mean, what is it? 99.9% of entrepreneurial ventures in CPG fail. So I think when you have some success the first time around and, you see what that looks like, it definitely gives you an appetite to do it again. And there's so many learnings in this space. So, once you're able to figure it out, and for me, I'm still constantly learning, to this day, I've been at it 17 years now. It definitely makes you want to do it again. And for me, I sold my previous brand, my previous business, and it was a different age and stage for me in my life. It was like a child to me at the end of the day, right? It was, we birthed it, named it, branded it, first ever salesperson, first ever anything in the company. And, in my case, what I realize is once you sell your business, it's not your business anymore. And there are certain things that happen with that business after that fact that made me want to get out there and do it again. And not only to prove it to myself, I could do it again too, but, set a good example for my kids as well, right? 37 years old, still plenty of energy left in the tank, wanted to get back out there and do it again. And it's also the relationships, right? The relationships you make in this industry, whether it's with, buyers of certain retailers or strength coaches of certain teams, right? Those people become your friends and your day to day. So why not just re-enter a universe that you're very comfortable in and that And I can tell you, well, after we sold the first one, I said to myself, I'll never do this again. This is insanity. And I was meeting with the team at Goldman Sachs. I was going to try and buy my old business back, actually. And they said to me, you might not get it, but we promise you, we've seen this a million times. You will start another one. You guys are crazy. And yeah, sure enough, they were right. I was wrong. So back at it.
When you sat down for your initial business plan of Cizzle Brands in general, you had the idea that, of course, you want it to be healthy and kind of geared towards athletes and then people who want to act like the athletes. But what were some specific things that you knew that, like, okay, I'm definitely going to hire out sales this time because I know that this isn't my thing? Or something where you said, okay, let's not even waste money on this because let's just skip to the step 2 because I already know step 1 is a bad idea. Well, what are some learnings that you had when you kind of set up that initial business model for Cizzle Brands?
Yeah, so the experience is, not to sound cliche, is priceless, right? So you know what to do, what worked in the past, what doesn't work in the past, and sometimes you just get that feeling, right? It's like, ooh, I know what that feels like. Let's not go there. So for me, it was first and foremost, you got to be passionate about what you do. So that's creating a best-in-class product. So with Quench Hydration being our flagship product, we created a best-in-class product. I can look anybody in the eye, whether it's the best athlete in the world or a family friend, and say, this is the best hydration product on the planet for the following reasons. So that right there, that's how you get the Andy O'Briens of the world involved in the brand, the Nathan McKinnon, so on and so forth. And you're passionate about what you're doing. You're providing everybody a great product. And then from there, our original team that we had in place in year 1 of the business, now we're in year 2, was they're more builders, right? Let's go out there and let's get all the teams back. Let's go get all the hockey arenas back, the soccer fields back, the kind of that grassroots groundswell, a lot of independent retailers that we had relationships with. And then from there, year 2 going into year 3 in a couple months, then we bring back our old commercial team, right? Those experts that are in the retail space. They know the Costcos, they know the Walmarts, the 7-Elevens, the Sobeys, the Loblaws, Trader Joe's, Sam's Club, you get it. I said all those, and they really have the relationships with those buyers and that expertise because, CPG, I've seen so many people that have excelled in other businesses attempt CPG. And what people don't realize when they first get into it is the intricacies in dealing with those retailers, right? The back page program, the rebates, the discounts, and how that's all handled from the back end of things, and how your sales team has to liaison with your ops teams in terms of demand planning and all the less glamorous stuff. So I'm of the belief, and based on my experience and my relationships, there's different folks that specialize in different phases of the business and also at different times in the business. So, that's how we looked at it. But step 1 was kicking off the products with Andy and getting some of my initial team members back to build that foundation. And step 2 here is really starting to commercialize the brands, in particular Quench.
In between kind of step 1 and step 2, you have access to a bunch of accredited investors through athletes and owners of teams and this and that. You have also the track record of doing this before. So traditionally, it would just seem that it would be very straightforward that this would be more of kind of a venture path. What made you want to go public and think that that's the easiest way to kind of raise capital to grow this fastest?
Yeah, I definitely felt it was the path of least resistance in regards to raising money, right? So I was a co-founder and CEO of a private CPG business for 10 years, and I spent the majority of my time having to justify valuation, argue valuation with investors, and that just took up too much time. When you're public, your valuation's right there. If it's a private placement, maybe you're going to give a 10 to 15% discount to market, and away you go. And also, one thing I noticed in my last turnaround was there's so many up and coming brands that I wanted to help out and perhaps incubate or acquire. And as a public entity, that makes it a lot easier, right? Because you have a currency to play with as well. So I like the rigor that comes along with a public company. I know it's a little bit more expensive to be public than private, obviously. It keeps everybody on their toes, and it definitely made raising money a lot easier, a lot less arguments over valuation. And also, for your shareholders, it gives them an exit. At the end of the day, if you're investing in a startup CPG company, well, you're going to have to wait forever for the company to pay dividends, or you're going to have to wait for them to sell the company. And I remember with my last venture, there was a lot of pressure to sell the business at one point. And here, shareholders can come and go as they please, right? So there's a lot of freedom that comes to having a public business as opposed to a private, contrary to popular belief. That's just my take on it, because I've now lived in both worlds, but access to capital was definitely made easier, and we've been able to show our investors, some great returns early on.
Well, and with it your second time too, you have already the discipline in place and such like that. So you're not, like you're saying, you're not afraid of being public because you're going to do everything right the second time through and be that much more organized and all that.
Yeah, my old business was acquired by a public company, so I got to exist in that world for a little bit of time. So a lot of learning came from that as well.
Okay, we'll move on to Quench. Quench is a sports drink, and now here's where I did my research from the outside, but please correct me if I'm wrong and tell me the real story. You're trying to sell Quench to customers, but at the same time, this co-packer factory comes up for sale, and then you're thinking, okay, not only can we package Quench there, but they're going to have excess capacity, so then we can start doing bottling of our great formulas for other customers, and then we're going to have built-in revenue, we're going to have vertical integration. Is this all correct, or am I just making stuff up?
No, you're not making anything up. That's pretty much correct. So what happened there, Will, was with my old business, after we sold, it was really ramping up. The Costco's, the Walmart USA's, you name it, and it became a capacity issue for us. So we went out and bought the Flow manufacturing facility. So Flow Water is a brand, and they had a manufacturing facility in Virginia. So my team that's with me today took that over from an operational standpoint. It was running at 29% efficiency, and within 6 months, we had it at 65% efficiency. So fast forward to Christmas Eve of 2025, when we closed this last transaction, 15 minutes from my house was the Flow Hydration Factory in Aurora, Ontario. This factory is the largest co-manufacturer of 500 ml Tetra Prismas in North America. If you don't own your own facility, you're either making it with us or you're making it in Mexico. There's 2 big facilities down there. So I was very familiar with the facility. We used to make our old product there, so I'd been there hundreds and hundreds of times. Very familiar. And
sorry, real quick, John, for people, you said 500 milliliter Tetra. For people to understand, it's just like a cardboard box that you would drink any sort of water out of. Yeah, so if anyone who is just listening, it's not as complex as he made it sound. It's a pretty standardized thing. So yeah, it must be everywhere.
Box drinks, sorry.
Yeah.
With the 500 ml Tetra Prisma, that's just industry jargon. So the senior secured debt holder, gentleman by the name of Cliff Rucker, who I had done business with in the past, foreclosed on the operation. And I have a relationship with Cliff. So we came to an agreement. I got the funding from OIC out of New York. We went in, we redid all the accounting, months and months of hard work between us and the OIC team. And we came to the realization that once a couple things were tweaked, with the current take or pay agreements that they had in place. So take or pay meaning if they don't make the product, they got to give you the cash. The place could do $18 to $20 million in EBITDA as is. So we paid $84 million for the facility. So let's call it roughly 4.5 times EBITDA. It just so happened that post our transaction, or right around the same time, Beatbox, who was the largest customer at our manufacturing facility, was acquired by Anheuser-Busch. So now Anheuser-Busch is our biggest client at the plant. Beatbox is still growing like crazy. Obviously, we manufacture our own product, Quench, a couple others. And we knew from our experience in Virginia that if we just sold 70 million more of these, whether through co-packing or ourselves, that we could get that facility to run at $40 million of EBITDA. So we researched this till we're blue in the face. It was a major transaction for us. For any Canadians that are on the call, they'd be familiar with this one. Waterloo Brewing just sold for 10 to 12 times EBITDA, right? So in the manufacturing space, especially with take or pay agreements, being valued around 10 to 12 times EBITDA is pretty standard. So we're well on our way to selling those 70 million more boxes for calendar 2027, which will get us to in and around that $40 million EBITDA range. And of course, with my background, I knew how important it was to be able to control our own supply chain. So that's why we're very happy with that transaction. That contributed to, the major growth that we had this last quarter. And it's also when you're speaking to retailers, they love to hear that you own your own production. If you're talking to a retailer like a Costco or a Walmart that can really, blow up your brand in a good way, they want to know that you control your own supply. So a very strategic move on our part that's paying huge dividends here early on, the Quench Hydration Factory for sure.
And since it's a hard asset like a factory, can you then too also take loans out based on it to help grow the Quench brand and such like that, since it's actually like a hard asset?
Yeah, so that's what we did to buy it. We
just to buy it. Okay, I didn't know if you're gonna take out more mortgages on it once it gets up to that 40 mil EBITDA to say, hey, we can do this again.
Yeah, no. So the only debt on that facility is with our lender OIC out of New York, and the EBITDA more than covers the debt.
You were conscious about actually naming this Cizzle Brands to start because you knew that you didn't want to just do one brand. You kind of wanted to do a family of healthy items for people to be able to consume and such. How much of your day-to-day CEO, I'm going to say from a pleasure side of things and then from a practical side of things, how much of your day-to-day do you spend on creating new brands and kind of doing the more fun side of things? Or is it the more fun side of things for you doing the PE stuff and looking at valuations of assets that are undervalued and not as efficient as they could be and more things you could bolt on to Cizzle Brands?
Yeah, I'd say it's more on the PE side. I do get involved in the fun stuff. I was just in a meeting right now where we were drafting some creative. We endorse Gavin McKenna, who's expected to go first overall in the NHL draft. So we have a shoot with him 3 days before the draft. So I did get to have some fun today.
Sweet.
I do have a lot of smart people around me, thankfully, that are great on the PE side and great on the creative side. So I get to dabble in both worlds. Whatever needs me most, I guess whatever is most urgent is where I go towards. But the House of Brands approach, Cizzle Brands, really comes from my learnings in the previous venture. So that brand, my previous brand was called BioSteel. And one error that I made there, well, as an entrepreneur, I made a million errors, but was I called everything BioSteel. So if the drink was called BioSteel, the creatine was called BioSteel, everything was called BioSteel, and it caused mass confusion, especially amongst parents who are purchasing the product because they're like, well, is it a creatine? Is it what is this? And then I would always get the question, can I get this to my kids? So with Quench, obviously, a way friendlier name, a way friendlier brand, and we've really been able to differentiate amongst the brands. So, if you're having your drink, it's Quench. If you're having your snacks, it's Snack Stars. And a lot of the times you're speaking to the same buyer from a retail standpoint. You're able to amortize your marketing assets across a portfolio of brands, providing more value. And also when it comes to shelf space, I mean, if you're getting an end cap, we can put our snacks on it. We can put our protein on it. We can put our sports drinks on it, right? So it was just learnings from the previous venture. And those learnings told me that, you should differentiate between your brand portfolio, not to cause confusion. And we've seen it on the other side of things. Like Prime was an overnight success in the drink space. Everybody knows about Prime because of Logan Paul and KSI and what have you. So where did they mess up? They messed up by calling their energy drink Prime. Because the parents were like, oh, I don't want this energy drink crap for my kids, even though most of the kids were drinking the sports drink, which still wasn't great for them based on the ingredients that were in there. But when they called their energy drink Prime, everybody thought there was loads of caffeine and all this other crap in the sports drink, and they just stopped buying Prime altogether, right? So, we all have our learnings from the space, and that's why I wanted to really create a House of Brands approach with Cizzle Brands this time around, with Quench Hydration being the flagship product.
Yeah, and then let's touch on, as we kind of wrap up here, your other two brands. What's the use case of why it's different, but what's the strategic thought behind Spoken Nutrition and Happy Eats?
Yeah, so Spoken Nutrition is your best-in-class supplement products. So, when you're dealing with the LA Dodgers or the New York Yankees, they get everything for free, right? They're sponsored by Gatorade or Body Armor, whatever big Coke or Pepsi brand. But really what the players want is something that's going to help them hit more runs and be more alert on the field and help prolong their career. So they're looking for best-in-class products. So with Spoken, we went out and created best-in-class products. So whether it's the best protein in the world, the best creatine in the world, ATP plus aminos, you name it, whatever the latest and the greatest is. And what that does is Quench is obviously best in class as well based on its nutritional profile, but it really opened up a lot of doors for Quench. So when I look at our pro sports business, it's actually 60% Spoken, 40% Quench, and Spoken's opened up a lot of doors for Quench. And on the Happy Eats side, it's just, we invest strongly into grassroots, youth grassroots, right? So we have about 2,000 youth teams across North America, and it's that usage occasion, right? So it's, okay, I need my premium hydration product because I don't want to be drinking a bunch of sugar from Gatorade out of a plastic bottle. So, we've captured them already, but then they're looking for snacks, right? So any parent out there, you're driving your kid to soccer, like, what are you giving them before soccer or after soccer, or before dance, after dance, hockey, whatever it is they're playing? Usually it ends up being chips or some kind of cookies or something like that. So what we went out and made, little, they're called snack stars. They look like little Rice Krispie squares, but they're actually good for you. And the bag contains 16 grams of protein. So if they're snacking on a couple of those before that, not only they're getting their protein intake, but they're getting something that's healthy for them, that's not loaded for sugar. So it just gave us another product and another brand to talk to the same audience that Quench was already speaking to.
Awesome. Well, for the next, say, 5 years, if everything goes exactly to plan, how do you see the kind of company shaping out? Is it having 5 more brands underneath the Cizzle Brands and then trying to each individually get into distribution? And then if one gets into distribution, you let the rest of the brands in? Or is it really focusing on Quench getting distribution as much place as possible and using that foot in the door to get the other brands into stores? Or kind of how do you see the company shaping up in the next 5 years if everything goes perfect?
Yeah, for us, Will, I'm firmly focused on 2 targets. One, it's $40 million of EBITDA on the manufacturing side of our business, which we're well on our way to doing. We expect to have that locked in on take-or-pay contracts for 2027. That's the goal there. Whether it's through our own products or our co-manufacturing, we believe we have a very, very clear path that's imminent in getting towards that. On the brand side of the business, it's $100 million in net sales. And considering that we're just getting into the world of club business, my previous brand, I remember we went from $10 million in sales to $20 million in sales to 50 to 100. Once you show that you're the proper sales velocities in the independent retailers, the regional retailers, that's when you start to get picked up nationally by the bigger accounts. So our velocities in those independent retailers, the regional retailers, are very good. And that's why we're starting to get some more widespread distribution nationally. So, we believe on the manufacturing side, we can be at that $40 million in EBITDA by the end of calendar 27. That's our goal. And then another 2 years or so on the brand side, give me 3, let's call it. We'll believe we'll be at that $100 million in net sales on the brand side across our portfolio. And for us, that's a strong business. That's with gross margins on the brand side of close to 50%, right? And when you add in the manufacturing margin, it still gives us a blended margin as a company, gross margin of around 40%. And in my training and working with the team at Goldman on my last transaction, those are kind of the gold standards in the industry, right? You can look at a value at 5 times sales if you have over 40% margin on the brand side, and anywhere from 10 to 12 times EBITDA on the plant side. So we're sitting at around I don't know what the stock says today, but 60 to $70 million market cap, maybe. And, when you take those numbers that are very, very achievable for us, you're looking at a total value around $1 billion in valuation. So that's where we have a clear path to, and that's what I'm fixated on right now.
No, I love the clear path. I love the clear numbers. Love what you're doing. As you mentioned earlier, my brother-in-law, who's an Olympian and NHL player for 18 years, he's been a big supporter of what you all have been doing for a decade plus and loves to kind of keep his body as healthy as possible. And so you all are a natural fit. If listeners want to learn a little bit more about Cizzle Brands, what you're up to, where should I send my audience?
Yeah, so you can visit us online at quenchhydration.com, cizzlebrands.com. Look us up on social media. Those would probably be the 2 best places. Or they can email into our info line, and we'll answer any and all questions.
Awesome. Sounds good. Well, for those of you still listening, please remember to subscribe and review. Thanks.
This podcast is for informational purposes only and does not provide financial, legal, or any other advice. The information is not investment advice or any offer to buy or sell any securities or to make any investment. The views expressed by the guests are their own, and any reference to third-party products, services, or information does not constitute an endorsement therefore by NanoCap Podcast or its affiliates. The NanoCap Podcast express disclaims all liability for any individual's use of the